China has been on most investors' horizons pretty much since the turn of the century. It's been a rocky ride, but as in everything, timing has been critical. Billionaire investor Ray Dalio, who founded Bridgewater Associates back in the 70s as a hedge fund, recently has been quoted as saying most are currently underweight China. But he thinks the right type of balance in China can yield positive results. Well, for this week's IG Trading the Markets podcast, we're talking to Brendan Ahern, KraneShares Chief Investment Officer, about Chinese stocks. Crane has a suite of ETFs, so can also discuss that market as well. But how a UK investor can sensibly increase their exposure in this area? KraneShares.eu provides written research which you can access. Let's now catch up with Brendan Ahern from KraneShares. Brendan, it's great to talk to you. What an interesting subject. There's tons to talk about in this podcast, but I want to begin, first of all, if I can, by a very simple, straightforward question. How hot is China at the moment for UK investors?
Well, I think China offers a tremendous opportunity. In the short run, China, as kind of first in, first out with this terrible pandemic, is experiencing a V-shaped recovery. They had a very, very strong quarantine. And so all signs are pointing to China is back to work. The economy is rebounding very strongly. And that's providing some very strong performance for Chinese equities.
In terms of the issues, very briefly, before we get into too much depth about the investment opportunity, what are the risks about investing in China?
Well, I think, investing in China, it's a country on the other side of the globe. There's language, different, obviously a big language barrier. There's a multitude, we're talking about thousands of stocks are Chinese companies listed in Shanghai, Shenzhen, Hong Kong, as well as here in the United States and certainly in London as well. So I think navigating opportunities can be difficult, and to some degree it's self-serving and highly biased, but I think that's where an ETF is a great way to gain exposure to China, because with a simple click of the button, you're fully allocated, right? You don't have to do the bottom-up research on companies whose documents might be in Chinese as opposed to English, as well as the ETFs allow you to gain a level of diversification to diminish single stock risk.
Let's take a look at this V-shaped recovery and the way that China is behaving at the moment, and indeed keeping in mind what Ray Dalio says about the fact that many are currently underweight China. What is it about this recovery you like, and where should we be looking within that recovery to take advantage of opportunities?
Well, for us at KraneShares, we've been very focused on, I think, a trend that's really missed a lot of investors globally. In our minds, we think about China as a export-driven, manufacturing-oriented economy. That's not the case. Over 50% of China's GDP today comes from the service sector. It's becoming more of a consumption-driven economy. And so, as you've had urbanization, a growing middle class, that middle class is using mobile technology to purchase. So as investors, we're very focused here at KraneShares on domestic consumption in China as it occurs online.
So where's that then take us? You talk about the various exchanges we can look at. Hong Kong, of course, might be an appeal because of the English language. What are you doing at the moment in terms of opportunities? Where are you moving into to give exposure to areas of interest?
Well, our flagship ETF, which we launched in the United States back in August of 2013, is called the KraneShares CSI China Internet. And so it owns U.S. and Hong Kong listed internet and e-commerce companies. So this is, the Alibabas, Tencent, JD, Pinduoduo. These are all companies that derive virtually all of their revenue online around rising domestic consumption in China. And I think this is where, in terms of comparing, KWEB is the ticker, which we've listed now in London. If you look at KWEB versus other China ETFs tend to have very high sector weights to old economic sectors, financials, banks, energy, industrials, materials, utilities, and real estate. And that's very different from these new economy stocks that we hold. And that's where, over the course of KWEB here in the United States, we've actually beaten the S&P 500, and that's very rare in the EM ETF world. That emerging market stocks have lagged U.S. equities for over a decade by less than half. But by owning the really this growth part of China, we've been able to outperform the S&P 500, and we're excited to bring KWEB to the London Stock Exchange and offer to investors in the United Kingdom.
Yeah, I'm just looking at KWEB at the moment. I mean, one of the nice things, of course, about this is, and indeed other similar sort of investment vehicles with exposure to China, is the fact you're dealing in dollars. Again, we're talking about different language. I mean, it's very difficult for people, easy perhaps maybe for people to invest in things that are dollar related. You still have that currency risk, of course, when you invest from the UK, when you're dealing in sterling initially. But exposure to the Chinese currency is an interesting one. Do you advise trying to avoid that sort of currency risk there? You mentioned Alibaba, for example, talking individual stocks as well. Alibaba is registered in the States. It's got a US listed share price, dollars. And again, one might regard investing in dollars through to a Chinese company a better way of doing it. Do you think that's the case, or are you happy with exposing investors to the Chinese currency?
We do offer a mainland China. So this is Shanghai and Shenzhen ETFs. The ticker that we've also listed in London is KBA. That does have a renminbi exposure. I think around the currency, there's a lot of misperceptions that actually the historical volatility, the standard deviation of China's currency is actually lower than the yen, euro, or the pound. And China has a very high interest rate relative to the United Kingdom and Europe and obviously, of course, Japan. But even here versus the United States, a 10-year Chinese treasury yields about 3.1%. And so, a lot of what drives currencies is the difference in interest rates. And so China's currency has actually been appreciating relative to the dollar and the euro, which is not what I think most people would think. So we're fine with holding, having that currency. At the same time, and at KWEB, what we found over time is a lot of the growth companies, in order to garner a global investor base, they've listed outside of mainland China. They've gone outside of the Shanghai and Shenzhen and listed in the United States as well as in Hong Kong. And that's just really because you've got these giant global asset managers can more easily access the U.S. and Hong Kong markets. So a lot of these growth names have gone outside of the domestically oriented Shanghai and Shenzhen market.
If you can keep your head
when all about you are losing theirs,
what possibilities might you see?
If you can see it,
the world is yours to trade and invest. See it. IG it.
Talking to a lot of investors here in the UK, there's there's a number of different ways you can expose yourself to the markets. One of the two main ways, one is growth, one is income. And we do tend to like our income shares, our income funds here in the UK. I know if you go into the States, it's not quite so common. What about dividend payments in China? Do they tend to avoid that? Is it really only all about growth? Should we expect to see a share price increase rather than some sort of payment along the way to keep investors happy?
In terms of the like global growth companies, the names we hold in KWEB tend not to pay dividends. They're really investing in the future growth of the company in terms of the earnings they generate don't get paid out in dividends. They get reinvested. And in the case of the companies within KBA, you do have, these are more traditional companies. They're much more mature. And so you do have a dividend payout of just over 2% in these Shanghai, predominantly Shanghai companies that, again, are really large mega cap companies, much more mature. So some element of the dividend payment is really the types of businesses, and that's not unique to China. I think that's really a kind of a global phenomenon.
Yeah. What about IPOs? We are reading about Jack Ma. Of course, we know the success that he has had in bringing Alibaba to the market. As I said earlier, it is quoted in the States. It's got its own listing in the States, but it is a Chinese company, obviously. And we know that Jack Ma is hoping to bring Ant Group as the next big IPO. I mean, this is going to command enormous amounts of money. What is it, first of all, about Chinese IPOs that the West likes so much?
Well, I think it's hard to find companies growing as quickly as the companies within KWEB. That, if you look at Alibaba's Q2 earnings, their revenue grew over 30%, and this is a $700 billion market cap company growing 30% year over year. But it's just not Alibaba. Tencent is over 600 billion in terms of market cap. It grew close, almost 30%. Pinduoduo, one of their arch rivals in e-commerce, grew closer to 70%. Their other rival in e-commerce, a company called JD.com, grew over 30%. So it's not just that these companies are big; they're actually growing really, really rapidly, and it's just very difficult to find companies of this scale growing as quickly as they are. And that's what would, really has people excited about Ant Group, where, you had the potential for the largest IPO ever globally. And we're talking about a company that is already very large in terms of revenue, but growing at a tremendous rate. So, investors are very, very excited. And within KWEB, we do have a fast track IPO inclusion process where a company over 10 billion in terms of market cap at listing, we're going to buy it on the 10th trading day after the IPO. So we'll be one of the earliest investors in a publicly traded Ant IPO globally.
And future IPO pipeline, are you hearing anything that is going to be exciting as well outside of Ant Group?
So there's been some chatter about Didi. So Didi is the proverbial Uber of China. And Didi is another, Ant is the largest fintech unicorn globally, but Didi is one of the largest, fastest growing private companies globally. And there has been some chatter about Didi coming public. And Didi put Uber out of business in China. And now, Didi sits on Uber's board as part of a deal they struck. So that's another very exciting company that we're, hoping will come public, if not in 2020, potentially in 2021.
Yeah. Let me just step back and take another sort of a wider look, but look at it from a big picture economic point of view. Again, referring back to your comment about the fact we've got this V-shaped recovery. What is China doing about things like debt? We hear a lot in the West about the fact that the markets are so indebted, the governments are so indebted. What's the situation like in China? Does China stand apart from all this, or does it have its own problems with debt? Is there an issue down the pipeline that's going to come through at some point and come back to bite investors in China? What's the outlook like if you look at it from that angle?
Yeah, so China, there is a debt issue. The positive would be that there is recognition at a government level that current debt issues are not a problem today, but have the potential to be a problem. And if you look at Japan went over 200% debt to GDP over 10 years ago. And why is that not a problem? Well, everyone would say, well, Japan's rich. And I think, something similar, a similar thesis can be applied to China, which is, yes, China has debt, which is a liability. But if there's a liability on the ledger, that means there's a balance sheet. And what's on the asset side of China's balance sheet? Well, tremendous savings. So if we take China and then minus M2, which is basically bank deposits, and then divide by GDP, you have a debt to debt less savings divided by GDP ratio of 50%. So China is very similar in Japan in that, yes, there is a higher level of debt, At the same time, there is a high level of assets, which kind of negates that. But I think most importantly for investors to recognize is in China there is a recognition. So a lot of the stimulus that we're seeing in China today to offset the economic consequence of the quarantine as well as the trade war is not being debt driven. This is not post global financial crisis where they went on this building boom that was really debt driven. There's recognition that the proverbial hangover from that debt driven binge is created a potential issue. So it's almost like shadow banking, Jeremy. Remember a few years ago, everyone was like, "Oh, shadow banking. This is what's going to be the domino that tips China." Well, they've eradicated shadow banking. That shadow banking, this peer-to-peer lending market that was happening off balance sheet, was recognized as a potential problem, and they basically eradicated it. Shadow banking is proverbially gone in China today because it was recognized as a problem. So again, policymakers in China are very attuned to potential problems and want to head them off at the pass.
One of the things going into the coronavirus, of course, was the trade spat between China and the US. One might regard that as a bit of a back window issue right now, I guess. But it is still nonetheless there, isn't it? I mean, if Donald Trump succeeds in getting into a second term in the White House, politically, there is not going to be an easy ride, I don't think, for China, is there? Is this something you're concerned about?
Well, I do. I mean, I do think that it takes two to tango, and so it's 2020, and the ability to communicate and talk to one another has never been easier. This is not Rome versus Carthage or Athens versus Sparta. It's like, come on, guys, guys and gals, let's get on airplanes and talk this out. I think a lot of just need to be aware of, and something that we've become very attuned to is. There's a lot of bark to what's being said, but there's very little bite. And that's because, for Trump's political base, being anti-China plays very well. At the same time, the US and Chinese economies are far more intertwined than is realized. And so, Trump, he talks a big game when it comes to some of this rhetoric. But if you actually look, what has he really done? Arguably nothing. And that's because if you hurt China, you actually hurt the US. And it's not just, Apple and Nike and Starbucks and, Caterpillar. You've got all these great US companies that are doing gangbuster business in China. It's the reality is that they do a lot of business with US firms. And if you're really worried about a escalation, you should sell your U.S. equities, because the reality is, it's about 50% of the largest 3,000 publicly traded companies in the United States have exposure to China, and U.S. companies generated, according to the New York Federal Reserve, $376 billion of revenue in China. If you jeopardize that, you should be very worried about U.S. equities, not Chinese equities.
Yeah, interesting way to look at that. One final question is about your attitude to things at the moment. I said at the top that Ray Dalio was suggesting that many are currently underweight China. Have you got a lot of cash sitting on the sidelines waiting to go into China? Are you fully invested at the moment? What's the situation about how you are invested at the moment?
Well, for ourselves, with our ETFs, we are always fully invested. That I think market timing is easily said, a lot harder to do. And I think even this past spring, where global markets came down very dramatically, even if you got out, your ability to get back in, I think, was probably very low. In terms of Ray Dalio's comments, it's globally, there's a benchmark called the All Country World Index, and that index is almost 60% the United States. Japan is almost 7%. China's 5%. The United Kingdom is 3.5%. Now, what's interesting is, so China is only 5% of the investable all-country world, but China is 16% of global GDP. And so, if we invested based on GDP, you'd have 3 times as much exposure to China. And I think the interesting thing about Mr. Dalio's comments is, one of the things he mentioned, Jeremy, was he actually contrasted China with India, where he said, India's markets, have a lot of potential, but their capital markets are really small. Well, from a investor's perspective, the definition of China for investors is 700 stocks with 2.6 trillion in market cap. India is 86 stocks with $500 million of market cap. So, 86 stocks versus 714. China is 5 times bigger than India. We know China is big, but you almost have to look at some of the data, really quantify it, and you realize, wow, China is really big, 5 times bigger from an investor's perspective than India. And I think that's something that we try to do at KraneShares, is provide that balanced perspective on what's happening there, because we do think there's great potential for global companies, British companies. There's going to be a lot of opportunities for investors there.
Interesting perspective. Look, we'll have to leave it there. But Brendan, thank you so much indeed for your time. It's been a pleasure talking to you with us there on the availability of Chinese investments for us here in the UK and the outlook as well. Brendan, thank you.
Thank you, Jim.
That's Brendan Ahern. He's KraneShares Chief Investment Officer, joining us for today's IG Trading the Markets podcast. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.